I think it's been interesting to note that the U.S. markets have outperformed the non-U.S. markets for a long time now, and I suspect that will continue, given the state of the political unrest outside the U.S. We have our own issues here, of course, but with what's going on in France and South Korea and various other places, and what I believe to be a continuing strength of the dollar. I think it's going to be hard to argue to not be overweight the U.S. for at least the next year or so.
You nailed it, Scott. And at what point does that exceptionalism become a victim of its own success? And at what point could, let's bring it back to Trump's economic plan, tariffs, taxation, immigration, deregulation, at what point could that become inflationary? And do we see yields and dollar meaningfully higher?
So I think that in the U.S., at least, the pressure on rates is up, not down, at least on the long end of the curve. I think the Fed is going to be much more cautious on cutting rates going forward. I do believe that they will cut 25 bips in December, but I think they may take a pause after that because the economy, the labor market, inflation, those numbers are just not supporting a continued aggressive rate cut regime. With respect to the dollar, as long as the Fed does not cut or does not cut as aggressively as originally intended, the dollar is going to stay strong. And so one area that I am encouraging my investors, my clients to consider is non-U.S. small cap stocks. I think the argument for U.S. small cap stocks is pretty strong. The valuation dispersion is as wide as it's ever been versus large caps. If Trump is actually successful in engaging his regulatory and tax policy, that should be beneficial for small caps. And outside the U.S., if you look historically, the smaller cap stocks in the EFA market and the EM market have outperformed. So I think that's a place people should be looking, maybe taking some gains out of their large cap stocks and reallocating.